Welcome back to the second session. This is on green jobs and innovation. I think it's a nice follow-up on the first session that we had. We are going to pick up on many of the different topics that we already talked about. We've heard that global energy investment is mainly in clean energy. So we've seen that this has been picking up in recent years, especially on renewables, but as well efficiency. And we also know that it's not enough yet, and we need a further acceleration. So here, of course, we are discussing also in this session on how technologies are evolving and how these breakthrough technologies are now entering the market, and not only how the clean energy is making up, but as well how the conventional energy is actually built out. Because given the energy crisis, we've seen that there is not only more interest in renewable energy, but as well more interest in fossil energy. And we see that this has been picked up in many countries in the European Union, for example. And so therefore, it's great to think a bit better about how the direction of technological change is going to evolve over time. And we'll have a paper that is going to be presented that is picking up exactly these technology challenges. With from Pia Andres from the London School of Economics, which is asking how is technological change evolving, not only given the development in costs and in business perspectives on these different technologies, but as well in terms of general purpose technologies and how they are actually driving technological change in one or the other direction. We have seen that these investments, they are coming up, but of course the problem is manifold. It's not only that we are missing the money. Well, that's probably solved at to some extent at the moment, given the high prices of energy in the markets. But we see that there are many other obstacles for these build out. In Germany, for example, we want to reach 20 gigawatts of photovoltaic build out every year from now on, and almost 10 gigawatt of wind, which means we do not only need the business models, but we as well need space. And we need regulation that fits. We need also people that can implement it. So I think it's very important that we will have another paper by Aurélien Saussay from the London School of Economics, who's looking at skill sets of workers, because we need workers that actually can help us implementing the green transition. And we will learn in the session more about the characteristics of these workers, of low carbon workers from empirical analysis. And then we will have two papers that are going to look at real implementation of policies and provide us with some ex post analysis of policy instruments. The one will be on feed-in-tariffs, and this will be the last paper in the session actually by Sugandha Srivastav from Oxford. I think it fits very well to what we have just heard about the France case. So you're as well going to tell us a little bit now about how these feed-in tariffs have actually benefited or disadvantaged different technology specifications for the UK case now. So now we have a nice setup with France, UK, and Spain. Because then we'll as well hear something about another policy implementation. François Cohen is going to tell us about the French case and the use of money that was not coming from the response to the current energy crisis, but actually to the response to COVID. We sometimes forget that we're already running out of another crisis, of course, and he's going to look at the impacts of the recovery packages, COVID-19 package. We heard a little bit about the Repower EU, but this is COVID-19 packages on energy retrofitting in France and the impacts on jobs. So this will be the program for the next 1 hour or so. Since we are a bit late, we will try to stick time schedule, 15 minutes for the presentation. We'll collect questions afterwards, and without any further delay, I would hand over to François.
Okay, well, thank you very much. And well, as I'm also part of the Energy Sustainability Chair, I welcome you here in Barcelona, and I hope for all of those that are visiting us from very far that you will enjoy your stay in our city. So this is a joint paper with Victor Kahn about basically a French scheme called the Energy Efficiency Obligation Scheme in France. And to give a bit of motivation about this paper, so basically we have had these large spending programs that have been committing us to nearly $1 trillion worldwide post-pandemic. And part of these large programs include energy renovation and home renovation. In the EU, it's about $200 billion that we plan to kind of like spend on this. And to understand a bit why we're spending so much energy, or we plan to spend so much energy on this, the first argument is because buildings represent a significant share of emissions. And the second reason is a political economy reason, because basically when we invest in home renovation, it's with the hope that it's going to create new jobs, especially low-skilled jobs in a general context where low-skilled workers may be left out of the energy transition. So there is this very strong political economy argument in favor of doing this. And while these policies are being rolled out, there is not so much information that we have about their value in terms of job creation. So in general, what people have been using is ex-ante estimates of potential job impacts, and there are very few ex-post estimates, or estimates after policies have been implemented, the expansionist policies have been implemented, on the job created from these policies. There is some effort done in the US, but it's quite general, so it doesn't like focus on energy retrofits in particular, and there is some work done in Spain for wind and solar energy, which are different sectors, and we would expect energy retrofits to have a higher job creation content. So that's the reason why we come up with this question, which is basically, well, what's the job creation content from having these large subsidies programs, looking at the very specific context of France, and basically what I'm going to show you is an analysis using a synthetic control method on French data from a discontinuity in the provision of subsidies that happened in 2018-2019 when the French program really took off. So that's what I'm going to show you, and I'm going to show you some estimates of the job created, in total about 15,000, which is 7.5 jobs per million euros spent on these subsidies in the short term. So to give you a very quick overview of the French context. So the French implemented one of the largest energy retrofit programs in the world, and this energy program works as such that you have obligated companies, especially utilities, that are forced to subsidize somehow home improvements by households. And the way it works is that they need to collect a certain amount of certificates, and the amount of certificates that they can collect depends on the types of operation that they end up funding. And these certificates, they have an implicit market value because companies can sell them to other companies over the counter. So we can trace basically the stringency of this policy by looking at the operations, the selling operations from this company and the buying operations from the company that tell us something about the overall market value of these certificates and therefore the stringency of the policy. So here you see the evolution of the stringency of the policy when it came to looking at, I think it's heat pumps. So as you can see, there is two reforms that come into place with like basically discontinuities in the value of certificates that happen in mid-2018 and in January 2019. And as you can see, we have really two different regimes before the introduction of these reforms and after the introduction of the reforms, with a much higher value, implicit value for the operations subsidized by the scheme. And the same happened with other types of operations. So I could enter into the details of all the operations, but it's a bit cumbersome and boring. But basically, we are going to exploit this discontinuity, looking at what happens after the first and second reforms. So to do this, we are going to use data from the French ministry that basically records how many employees you have in every business in France. So the data has improved over time. So to avoid inconsistencies in the data, we're basically using what the Ministry of Labor has been doing, which is giving some weights for earlier years, where basically the data is incomplete, but there is sufficient information for later years to kind of like fill up the gaps. So that's what's being done. So we're using this data And because it is a bit patchy, what we're going to do is aggregate the information at national level, where estimates for total employment in different sectors are more reliable. And we're going to compare sectors from one another, looking at monthly differences in job levels from one sector to the other. We have about 680 sectors to work with. So here's some general descriptive statistics. So in bold, what you can see is the employment levels as recorded in our data for energy renovation. And in light gray, what you have is the overall employment trend for the country. As you can see, there is a discontinuity in 2016 that has to do with the way the data is collected, but this inconsistency appears to be more or less the same, meaning that there is an equal increase, an equal jump in employment levels in 2016. This is something I'm going to talk a bit about more later in robustness checks, because this could be a problem for the methodology that we're going to apply. But in general, what you can see is that we have this type of information. And so what we are going to try to understand is, well, what would have been the employment level in the energy renovation sector in the absence of the policy? And for this, we are going to build synthetic control. So basically, it's a weighted average of other sectors in the economy that were unaffected by the policy. And in this case, it's quite simple to see why other sectors would not be affected, because these subsidies basically went to fund energy renovation. So the way we build these synthetic controls is that we we do two things. The first thing is what we exclude from the potential pool of control sectors, the sectors from the construction sector, because they could be also indirectly affected by the policy. And we also follow some rules by the creator of this method that basically says that we should only look at sectors that have more or less the same size as the sectors that we're interested in. So we kind of put upper and lower bounds for the total number of employees that there could have been in the sectors from the donor pool to create the synthetic control. So that's what we do. And as soon as we've done this, so what we are able is basically to create a synthetic control that has the exact same pre-treatment trend. So basically, before the introduction of the first reforms, the model calibrates the weights for the different control sectors such that there is no difference in trends. And then we look at the difference in trend. As you can see, what we observe with this method is a gap after especially the introduction of the second reform, which is the strongest reform in employment trends. And if we stop the analysis before COVID-19, which we want to do to avoid potential contaminations from very, very strong changes in the sample after COVID-19, what we can find is an increase in employment by about 15,000 people. So the question is, a problem with this method is that statistical inference is not as simple as with standard regressions, because you don't have a 95% confidence interval as easily. So what you can do, and what is being done in the literature, is to construct what we call an inference score. And the way this inference score is constructed is a bit tough to understand, so I'm going to try to give you the intuition. So first, you need to imagine that for each sector in our donor pool, we could create another synthetic control for the evolution of employment in this sector using exactly the same method that we have used in the treatment group. And therefore, what you would have is, for these synthetic controls, for each control sector in our donor pool, we would have a synthetic control, and we would be able to compare basically how this synthetic control fits with the control employment level before and after the policy. And what we are interested in assessing is if, in the case of our treated sector, there is a substantial gap in employment after the policy, and we don't observe the same difference in employment in the control sectors. And so to do this, what you are basically doing is looking at the model fit before and after the policy for the treated control and its synthetic control, and the control sectors and the synthetic controls. I think this is a bit obscure, so I'm going to give you an image and hope that you get this. So if you look at here, yes, you have a very good model fit before the introduction of the policy, but after the introduction of the policy, naturally, you have a big gap. And what we think is that this big gap is explained by the policy. So if you did this on control sectors, what you would hope is that the gap is very, very small or very similar before and after the implementation of the policy, because the policy should have no impact. So that's basically what we're going to use. There is a mathematical equation for this, but it's basically the way this is built. So when we do this, what we create is all these synthetic controls, and we can look at the gap before and after in terms of like the difference between the control and the synthetic controls, and the treatment and the synthetic control for the treatment. And as you can see, what happens is that in the case of the home efficiency sector, we tend to predict an increase in employment that is in the top 20% of sectors for which we are able to reproduce the same analysis. But what really matters is not whether we are in the top 20% or in the top 5% here. It's that comparatively, you have sectors that have very strong variance in the way we can estimate these things. And these sectors, basically, since they have very, very strong variance, they can probably like provide you very high results that are incredibly high and incredibly low because the model fit is quite bad. So that's what we are going to control for with this inference score. So when we do this, what we realize is that, in fact, the model predicts the worst what happens to the energy renovation sector compared to any other sector in our sample, which is exactly what we want. We want the model for the synthetic control to be a very bad predictor of what's going on, meaning that it means that the policy has an impact that is not captured by the synthetic control. So that's what we do find. We're capable of calculating whether this difference in estimates is statistically significant or not, and it happens to be statistically significant. We can look at whether doing several research checks, whether it's statistically significant at different times. So before the introduction of the second reform, it's statistically significant at 10%, and then it becomes statistically significant at 5%. And we can also calibrate it with different, as I explained, we can basically choose a narrower or wider set of sectors to be part of this synthetic control based on the calibration by Abadi that says that a sector shouldn't be too big or too small compared to the main sector. So that's what we do, and we find the results that are consistent with these robustness checks. So another robustness check that we do, which is quite important, is to imagine that maybe we want to be sure that there has been no anticipation of the policy. So if there is an anticipation of the policy, then naturally the moment when you should start looking at impacts is not when the policy starts, but before. We find no such evidence of an anticipation. And the last thing that we want to look at is to be sure that the gap in the data for 2016 is not creating a big problem with our results. So then we calibrate the model excluding the data before the gap, and we find very similar results, suggesting that this employment effect is valid. We also look at the impact for other construction sectors, since there could be spillovers for other construction sectors, and what we find is that there is an impact for construction sectors that deal with what is called specialized construction. So basically when you kind of like do other stuff that is not heating or insulation, but has to do with home renovations. And we don't find an impact on new homes, which is again quite reassuring, because we shouldn't find an impact on new homes for home retrofits. So altogether, what I wanted to show you is basically, well, this like synthetic control model where we can basically infer that there has been a job creation by 7.5 jobs for €1 million invested in a scheme. And this is quite close to ex-ante analysis, meaning that the forecast for job creation may be quite close to what we have found, which is a tiny bit reassuring. We can try to draw a few comparisons with previous work. So there are only two other studies that have tried to look at this type of questions, looking at expansion programs. And what is quite interesting is that our estimates are a bit higher. And it kind of like confirms the story that home retrofits would be a better fit to create new jobs compared to other types of interventions, especially wind. So there's this Faber and other papers on lack of job creation from investing in wind compared to investing in solar. But the problem is that estimates are not fully comparable. So it's you know, that's a limit. And in terms of next steps, so this is very much work in progress. But what I basically want to do with my co-authors is to extend the analysis using a more detailed model, because you're using like national aggregates, and we want to do like the same type of analysis with disaggregate data, which is quite like new and trendy in the field, and we want to be able to say something a bit more about full effects. So because this is very much partial equilibrium, since there could be an impact on energy prices, we want to discuss a bit this a bit more in the paper. So thank you very much for your attention.
Thanks a lot, François. As I said, we are collecting questions for the time after all presentations, and we move now to the next one, which is Pia Andres from the LSE on directed technological change and general purpose technologies. And now it's me first, finding the presentation. That's it, probably. And good.
Great. Which here? Perfect. Thanks very much for the introduction. It's a great pleasure to be here. I'm going to be presenting a working paper that's co-authored with Eugénie Dugois and Marion Dumas from the London School of Economics. And this is also a chapter in my PhD thesis, I'm happy to say. So you've probably been hearing a lot about AI and how it's coming for our jobs or coming to write our papers, depending on which way you look at it. And maybe there's some reason to believe that it's also coming to save the climate, because there's a lot of potential for AI to enable clean technologies through smart grids or more efficient heating and cooling systems, like what you see in the infographic here. But AI can also help us do other things more efficiently, like drill for oil, which maybe isn't such good news. So what we do in this paper is we want to look at what are the implications of the arrival of a new general purpose technology such as AI for the dynamics between two competing technologies. And we first look at this from a theoretical point of view. And then we also empirically examine, using patent data, whether clean or dirty technologies in transport and electricity tend to draw more on AI. And we then also look at the role of firm-level spillovers in driving what we observe there. So just to give you an overview over my talk, I'm going to start with some background about the economics of general-purpose technologies. Then I'm going to show you our main theoretical results, and then I'm going to go into the data and the empirical results, and then at the end I'm going to give you a quick overview. So the economic theory of general-purpose technologies tends to focus a lot on the effect of GPTs on growth, and not so much on their effects on the direction of technological change. But what we do learn from this literature is that the adoption of a GPT doesn't necessarily happen automatically, but actually requires co-invention in the adoption sectors. And the speed with which a potential adoption sector will adopt it can depend on a variety of factors, like sort of the intrinsic technological complementarities, how much has been invested in adopting the previous GPT, the costs of adoption, and so on. And we also follow Cohen and Leventhal in considering absorptive capacity to be endogenous. Now, what is absorptive capacity? Is the idea that a technological spillover isn't going to happen just like manna from heaven, but actually in order to benefit from advances in another technology, you have to also do your own R&D and learn to understand it. Okay, so in terms of the theory, we draw on the seminal paper by Asimoglu and co-authors in 2012 in the AER called The Environment and Directed Technical Change. And what you see in this diagram is basically the intuition that technological change is path dependent. And generally speaking, inventors are going to continue innovating in the incumbent technology because it has a larger market. And so whichever technology, clean or dirty, has seen the greater productivity improvements in the past will tend to be the one that everyone kind of continues working on. And in between here, you have this gray area of multiple equilibria where, things can go kind of either way. And what we do with this model is we introduce a general purpose technology, which basically has the effect of increasing the productivity improvement that comes with a successful innovation. And our first result is that even if both clean and dirty have the same potential to absorb the new technology, this will actually increase the area where multiple equilibria are possible, which is already quite encouraging. But also, and perhaps less surprisingly, if the clean technology has greater absorptive capacity for the general purpose technology, then we would expect the area where innovators are going to coordinate on a clean equilibrium to increase. So in terms of the empirics, we draw on the EPO's PatStat database for patent data, and we identify patent families that are related to AI or general information and communication technologies, as well as technologies that are related to electricity or transport and that are clean, gray, or dirty. And we do this using a combination of keywords and technology codes. Now, for example, a clean electricity technology would be a solar panel, a clean transport technology would be an electric vehicle, a gray transport technology might be a hybrid vehicle, and a dirty one would be an internal combustion engine. And we then also match this data to the Orbis database to get firm-level information on assets and turnover and things like that. So what do we find? We find that clean and gray technologies tend to draw more on both AI and ICT. And here you see this for AI. So you see the average percentage of citations that clean, gray, or dirty patents make to AI patents. And you can see that especially in transport, green technologies tend to draw a lot more on AI than dirty ones. So what I perhaps should have clarified for those not working with patent data, basically when you file a patent, you have to cite the other patents that your technology builds on. And so we exploit this kind of aspect of patent data to look at which technologies these new inventions build on. And here we show the same thing for general ICT, so information and communication technologies. And we kind of observe the same thing in the sense that clean technologies tend to use it more, but now electricity is the one that has the much larger gap between green and dirty. We also run some regressions that allow us to control for things like the size of the patent family, measures of quality, like the numbers of citations that it has received, and firm fixed effects based on our match to Orbis. And using these regressions, we can show that even when we control for the quality of the invention, we still find that clean technologies draw more on AI and ICT. And then finally, we look at the role of firm-level spillovers in driving these dynamics, because our theoretical results show that we would expect investments in absorptive capacity to increase if the stock of knowledge in the general purpose technology that is available increases. And we do find that firms that have a higher stock of AI knowledge, as measured by the past patents that they have filed in AI, they tend to absorb a lot more AI in their energy innovations. So this suggests that firms that innovate more in clean, they also tend to have better AI knowledge, but this doesn't explain all of the difference between clean and dirty that we observe. And we also find that firms that have a higher stock of energy knowledge tend to absorb less AI. So we can kind of infer from that the absorption of digital technologies in clean energy technologies is kind of mainly driven by firms that have more knowledge in a digital technology and less knowledge in energy technology. Yeah. Right. Well, here you can just see the average percentage of patents that each firm has in its portfolio that cite AI or ICT over time. And you can see that ICT is absorbed a lot more than AI, which we would expect because there's just a lot more ICT knowledge out there. But you can also see that green dominates dirty in both ICT and AI, and in AI especially, this gap widens over time. And then, as before, we also do some regression analysis where we use as the dependent variable the count of the firm's family that cite AI or ICT. And then we include some firm-level controls like total assets or number of employees and the age of the firm. And yeah, we find that firms with higher stock of AI and a smaller stock of energy absorb more AI. And we also find that in clean transport portfolios, there's a positive interaction effect between having a higher stock of AI and being clean. And we think that perhaps this means that there's an intrinsic factor to the absorptive capacity of clean transport for AI. So just to summarize, a general purpose technology, according to our theory, can lessen the path dependency that favors incumbent technologies like fossil fuels. And so this brings us some hope that the arrival of AI and the AI revolution can be a good thing for clean energy innovation. And we also show empirically that clean technologies in electricity and transport have drawn more on AI and ICT. And we find some evidence that this can be partially but not entirely explained by firm-level spillovers. Yeah, that's it from me. Thanks very much.
Thanks a lot, Pia, for the presentation. And well, I think there will be some questions afterwards. But now we are moving to Aurélien, and he's going to talk a bit more about the skills of low-carbon workers. So Aurélien, please.
Thank you very much, Andreas, and thanks for your invitation. It's a pleasure to be here. So, well, while the slides appear, maybe no, they still haven't appeared, but so essentially the genesis of this paper has been the question of how to define green jobs and low-carbon jobs. So this is a terminology and expression that policymakers love to use. We've all heard that in debates around the European Green Deal or the Green New Deal in the US, that the energy transition is going to create millions of highly paid, highly qualified green jobs. But this concept of green or low-carbon job is not very well defined. And there's good reasons for that. These are relatively new jobs. They're quite diffuse or dispersed across the economy. They're not concentrated in a single sector. So it's quite challenging to really identify them. And by contrast, on the dirty side of the spectrum, the labor force, or like high carbon or fossil-intensive jobs, those are jobs that have been with us for more than a century. We know which sectors they're in. They're very visible. And so you get into this argument in the public debate around the low-carbon transition that on the one hand, there's a lot of jobs at risk, because they are very visible on the high carbon end of the spectrum. And on the other hand, there's a lack of visibility, perhaps, as to the breadth of low carbon jobs. And so initially, when the first forays in the literature were made to try to define these jobs 10 odd years ago, the first idea was to maybe look at sectors. But the problem is very few sectors are either completely low carbon or not, so that's much too broad a brush to paint this picture. So maybe we should look at the firm level or the occupation level. And so here in this paper, our approach is that we're going to try to characterize low carbon jobs, but whether the skills they require can be construed as low carbon skills. So the big advantage with that is that we're going to be able to observe heterogeneity within occupation, because even at the occupation level, few occupations can really be considered wholly green. So to take an example I will use throughout the presentation, if we look at chemical engineers, for example, which is the most detailed level both in the European and American classification of occupation for engineers, You can have a chemical engineer that would be clearly fossil intensive if they work in the petrochemical industry. Conversely, you can have a chemical engineer working on improving the effectiveness of solar PV cells or the effectiveness of insulation material, which would be considered as contributing to the low carbon transition under the methodology that I'm going to present. And of course, for most chemical engineers, they're neither low carbon nor high carbon. Maybe they work in the pharmaceutical industry or some totally unrelated industry. And so to develop this, the data set we're going to use is a data set of online job ads. So we partnered with a private provider called Lightcast that provided us with the universe of all online job ads in the United States over a period of 10 years, from 2010 to 2019. So it's a fairly large data set, almost 200 million job ads. And for each of these, we observe which occupation is being advertised. We observe in some cases, the compensation offered, the education required, but most importantly, we observe a set of skills that the employer expects the candidate to have to fulfill the position. And so that will allow us, again, to characterize multiple types of skill sets for a given occupation and to compare the low carbon and non-low carbon version of the same occupation. So I'm not going to bore you with a literature review in this short presentation, but just the types of strands of literature we contribute to. Obviously, the identification of green jobs, but also the labor market impacts of low carbon mitigation and climate change mitigation policies, and also how the labor market responds to a technological transition, here in this instance, the transition to low carbon technologies. So in terms of coverage, as you can hopefully see, we have quite a broad coverage of the entire labor force. But of course, because we are looking at online job ads, some occupations are overrepresented and other underrepresented. In particular, so this is the US standard occupation classification, because we're working on a US data set. One nice feature is that the first half of the classification roughly is high-skilled jobs, so everything numbered under 30 in this slide, and everything below is low-skilled jobs. So as we would expect with online job ads, high-skilled jobs are overrepresented, particularly in ICT, and low-skilled jobs are underrepresented. But the good thing is, because we have such a big data set, even for important low-skilled workers for the energy transition, like construction workers or installation maintenance workers, we still have millions of observations, millions of ads to work with, despite their underrepresentation compared to the labor force. So what do we observe? What's in one of these ads? So as I was saying, we observe the job titles. We know which occupation this ad is linked to. In some cases, again, roughly a third of the data set, we also observe the compensation, the level of experience required, and crucially, we observe this set of skills. So skills is the terminology that's used in the labor economics literature that uses this data set, and also by the Lightcast company themselves. But in practice, it might be better to think of these as job identifiers, if you will, because some of these, as you can see, can be technologies like fuel cell. Some of these are very broad skills like problem solving. So it's really like characterization of the occupation based on a set of job identifiers, some of which are tasks, some of which are skills, some of which are technologies. And so the first and most important contribution of our paper is to try to develop a methodology to classify jobs into a low carbon and non-low carbon category based on these skills. So what we're going to do is we're going to apply natural language processing techniques to first extract low carbon keywords from source texts, and then use that to classify the skills in this data set. So one word about the data set before I moved on to the methodology. The length, so the number of skills that characterize each ad is highly heterogeneous. As you would expect, high-skill occupation have a lot more skills than low-skill occupation. That makes a lot of sense. But the spread within each occupation is also pretty broad. And that has to do with both the fact that different employers will provide more or less details when they advertise a position, but also a very pedestrian reason, which is that those are online ads advertised on online platforms, and certain platforms offer you more room to describe a position that you are advertising. So in some cases, that'll just be one paragraph. In other cases, there's no length limits to the content. So in those cases, of course, there's a lot more to extract job identifiers from when there is no length limits. So the methodology. We start from established classifications of green and non-green occupations. In practice, we use the ONET classification in the US, which since 2009-2010 has produced a list of green tasks. So essentially for each occupation in their classification, the ONET classification provides a set of tasks that characterizes the occupation. Some of these are green, others are not, and for each of these tasks, there's a text that describes the task, sorry. So what we do is we contrast the text describing the green tasks to those describing the non-green tasks. That allows us to tease out low-carbon keywords that are characteristic of the green tasks. Then we do exactly the same thing on the ProdCom database, which is a database often used in the trade literature, which has also an established list of climate change mitigation related products that is actually used in the WTO negotiations to establish which of these products can benefit from lower tariffs. Same methodology. A description for each of these green products is provided by the ProdCom database, contrasted using an algorithm called TF-IDF, text frequency inversed document frequency, to extract low carbon keywords from the ProdCom database too. So at this stage, we have a set of low carbon keywords. Then we want to match that with our online job ads dataset. So we could have done a simple fuzzy matching. The problem is that is highly sensitive to the type of vocabulary that is used in each of the two datasets. So to alleviate that issue, we apply an NLP technique called semantic matching, where essentially the matching score is calculated by how close semantically the two words or bigrams that we are matching actually are. And so that allows us to match those low carbon keywords we extracted to our set of skills in the online job ads dataset. So at the end of this methodology, the number of unique skills in the online job dataset is quite large. There's 16,000 of these unique skills. We obtain a list of 450 low carbon skills that will allow us to characterize which of the job ads are low carbon or not. And the way we do this, because of the heterogeneity in the length of the skill vector, the number of skills for each job ad, is if one job ad contains at least one low carbon skill, we classify it as low carbon. So to get back to our example, in this instance, because this job ad contains fuel cell as a characteristic skill of that position, and because fuel cell is one of our 450 low carbon skills, this would be an example of a low carbon ad in our dataset. So then, based on that, that allows us to draw a number of results. First one is we looked, of course, at the evolution of the share of low carbon ads in the US over a period of observation. Two highlights here. The first one is that the share is relatively low, 1.5%, roughly 1.3, 1.5% over the period. So that may appear as low, but if you contrast that with the share of high carbon jobs, which we also analyzed in our paper, so around 0.4 for the period, so it's already more than 3 times larger than the high carbon share. The other thing to remember is that the way we approach the classification of low carbon here is positions that contribute to decarbonization. So these are jobs that are actively engaged in the transition to the low carbon economy, not just jobs whose carbon intensity has been decreased by an external action. Another thing that's important is that we look at the differential evolution of low-skilled and high-skilled proportion of low-carbon jobs, and we see an increase of low-skilled and decrease of high-skilled positions. So that might appear surprising initially, but that actually jives pretty well with other results in the literature, particularly looking at green patents, which have peaked through that decade, through the 2010s, and have been on decline since 2014, 2015. And that also is quite coherent with the move from the most R&D intensive phase of decarbonization to the implementation phase of decarbonization. As François was reminding us just earlier, that actually requires a lot of low-skill work. If you look at energy retrofits, for example, which is probably the biggest, at least in Europe, labor-intensive portion of decarbonization, that's low-skill work. If you look at installation and maintenance of renewables, that's low-skill work. Deployment and operation of public transportation networks, also mostly low-skill work. Then, in terms of where these low-carbon positions are concentrated, on the high-skill end of things, business operations specialists, engineers, no surprises there, physical scientists, also no surprises there, is where most of the R&D towards decarbonization is located. And on the low-skilled end of the spectrum, construction and extraction, of course, mostly construction. Extraction workers are mostly tied to the oil and gas sector, so nothing to do with the low-carbon transition. Installation, maintenance, and operations, again, for most of the renewables or energy efficiency systems, you need those workers, and also transportation for the deployment and intensification of public transportation networks. So one really big advantage of our approach compared to what could be done previously in literature is that we are able to contrast for a given occupation the low carbon and non-low carbon version of that occupation. And so we can compare the skill set required for the low carbon version of each of the occupations that we can examine in our data set and look at whether those low carbon positions differ in the skill set they require. So there's a lot to unpack here. The way we did that to try to make it manageable is we grouped the skills into 5 broad categories that are commonly used in the labor economics literature. So cognitive skills, IT skills, management skills, social skills, and technical skills. And then we looked at the share of ads for each of these occupations that required one of these 5 groups of skills in the low carbon version, so that's the green bar, or in the non-low carbon version, that's the yellow bar. And for those occupations that also had a high carbon or fossil intensive version, that's the orange bar. In terms of stylized facts, low carbon jobs do require on average more skills than their non-low carbon counterpart, so they are more skills intensive. But in terms of the skills group that matter more for low carbon, that's quite heterogeneous across occupations. One thing that's quite consistent is that managerial and cognitive skills are more present for low carbon positions than for non-low carbon positions. The final stylized fact here is that high carbon and low carbon positions tend to be closer in terms of skill sets than either of them are to their generic counterparts. So that's quite reassuring in the debate about what are we going to do with those people that will lose their jobs in high carbon sectors if they need to transition towards low carbon positions. So these are for the low skill occupations, the same results. The stylized facts are fairly similar. So I'll skip that for the interest of time. Another thing that we can look at is the spatial distribution of low carbon position. So what we did here is that we looked at the unit of observation here is the commuting zone, which is essentially the cohesive labor market area in the United States, usually organized around a central city. And so the darker the green, the higher the proportion of low carbon jobs. We find quite expected results in that the Western states where low carbon or climate change mitigation policies are the most ambitious have the highest share of low carbon jobs. Same thing in New England, on the northeast of the United States. Around the Great Lakes, a lot of wind power resource, so a lot of green jobs. And then we have this wind corridor that starts from North Dakota and that goes all the way down to southern Texas, where you also have a higher prevalence of low carbon jobs. And then we wanted to look at the overlap with high carbon jobs, which is where the job destruction are going to happen. And so on the left-hand side, it's with the overlap with high carbon ads, and on the right-hand side, the overlap with high carbon existing jobs. Because a lot of these high carbon positions are actually not necessarily new positions. If you look at the coal mining industry, for example, they hire very little, but these are very important in the policy debate around decarbonization. And so what we find when we do some correlational analysis that I haven't included in interest of time, but that I will mention just orally, is that first, the overlap is limited between low carbon and high carbon position, but the most important part is that high carbon positions tend to be geographically quite concentrated, whereas, as you can see, low carbon positions are quite a bit more spread out. And the thing that's more challenging is that high carbon positions tend to be the well-paying jobs in relatively impoverished areas. So that's true in the United States. We've also conducted analysis in the UK. We also find that results. So I do not know yet whether that will generalize to the rest of Europe, but at least for the United States, that's quite a solid finding. And that means that when you lose those positions, the impact on those communities is enhanced by the fact that they were the best paying position, or actually better paying position in relatively impoverished areas. Low-carbon jobs do not share that feature. They are not better-paying jobs in relatively impoverished areas. They tend to be more created in areas that are already richer than the median county in the United States. So that's a potential challenge in terms of distributional impacts of the low-carbon transition in the labor market. And finally, what we've also wanted to look at is whether those green jobs commanded a wage premium. So those are Mercer-type regressions we control for level of education, the length, the number of skills required for the number of years of schooling required, and also for local job market area. So these are conditional wage premium. And essentially, so the lower figure in each instance is the premium we were estimating at the beginning of our sample, so from 2020 to 2012, and the upper one with the triangle is the latter years of our sample, 2017 to 2019. And what we see quite consistently across occupations is that at the beginning of our observation period, most occupations did command a wage premium, but towards the end of our observation period, unfortunately, that premium had mostly evaporated, and it was no longer any statistically significant premium. So the problem in this instance is that there are a number of potential explanations for this stylized fact. We do not have the possibility with our data set to discriminate between them. Just to list three, the first one could be that employers do not recognize the value of those green skills, that do not compensate accordingly for them. A second potential explanation that we can actually test, and we did test in our data set, is whether those low-carbon positions have become more similar to their non-low-carbon counterparts, and that indeed is something we do find. The skill gap has shrunk over time between low-carbon and non-low-carbon positions. And a third potential explanation would be the halo or feel-good effect, if you will, that employees are willing to accept a pay cut or lower pay just because they are working on saving the planet, so to speak, in a sector or an activity that makes them feel good enough about themselves that they accept a lower pay. And that's something that I think anecdotally we all know something about working on climate change research in academia. So unfortunately, at this stage, we cannot discriminate between these three potential explanations, but we definitely do not find this turning back to the way green jobs are portrayed by policymakers as highly paid and numerous. These two facts are not really borne out by the analysis. So in conclusion, we do not find any increase in the overall demand for low-carbon jobs in the 2010s in the United States. Again, that's a period where there hasn't been much happening at the federal level in terms of climate change mitigation policies in the United States, so that should not be too surprising. But we do see an increase in the demand for low-skill, low-carbon occupation, and a reduction in the demand on the high-skill end. We do find in terms of the characterization of those low-carbon jobs that are more skills-intensive, but they do not command a wage premium, which might be tricky in terms of attractiveness of those positions, because if there are more requirements of skills but not a commensurate increase in pay, that might reduce their attractiveness. And finally, this methodology, we believe, that we've developed is highly replicable, and it's a powerful way to have a live monitoring of the low-carbon transition in the labor market. Case in point is an illustration of its reproducibility. We have just conducted a reproduction study in the UK on a comparable data set, and we're able to derive very similar results using the exact same approach. So that's something we believe would be extensible to Europe and other national contexts. Thank you very much.
Thanks a lot, Aurélien, for this interesting talk. And now we move to the last one, which is, again, ex-post analysis, but now on PV and feed-in tariffs. So this is Sugandha Srivastav from University of Oxford. This is a bit of an UK panel, I realize, but please go ahead.
Great. I'll wait for the slides.
Yeah, well, slide.
Okay, perfect. Well, thank you firstly for inviting me to this conference. I really thank the organizers, and also such a pleasure to be part of this panel. So essentially, I'll be talking about bringing breakthrough technologies to market, and I think everyone in the room will agree that we have a huge innovation challenge ahead of us. And by the way, I'm Sugandha. I'm a British Academy postdoc at Oxford. I also just finished my PhD from there recently. So all feedback is very much welcome, and please be critical. All right, so bringing breakthrough technologies to market matters for many challenges, not just for climate change, where we need to reach net zero. And net zero means that we have to decarbonize aviation, long-haul transportation, shipping, materials. We need new solutions on the table for net zero. But also, we've just come out of one of the world's largest catalytic events, which was the pandemic, where we had to bring a breakthrough technology to market at breakneck speed to save lives, and that was vaccines. On top of that, we've had secular decline in productivity as measured by conventional metrics for years now. So we also know that technology is a driver of productivity growth, and in the context of the productivity decline, it matters. So for this talk, I'll be focusing on climate change, but the question of bringing breakthrough technologies to market is as old as time. So why can't we just pigou our way out? And my hope was that this catchphrase would catch on, but it's because we have many market failures. It's not just the environmental externality and pricing carbon, but as Pia and others have discussed, we have innovation spillovers, and we need to take into account those. But then on top of that, we also have incomplete information. If you have never seen a technology before, you don't know the distribution of risks, you don't know the distribution of returns, you don't even know how it will look like once it's operationalized. How do you write an insurance contract for something you've never seen before? How do you price in things that you just don't know? So there is fundamental uncertainty, and that will be the case for these new technologies. Now, I'm going to talk about the specific market failure here, and it is the fact that there's incomplete information. What that can do is it can lead to an increase in the cost of capital, because investors tend to be risk averse. If you don't know, you will just kind of price that in. And it can also lead to uninsurable risk, right? So a lot of new technologies would like to have insurance contracts, but the data very clearly shows, even for renewable energy in the early days, the markets for insurance were not well developed at all. You just didn't have these products. So this almost creates this chicken and egg problem. You need a couple of projects to show what the risk and returns look like. That helps deepen the markets for finance and insurance, which then leads to more projects. So you need the projects for finance, and then you need the finance for projects. So how do you get this thing started? And my empirical context will be utility-scale solar in the UK. I look at 2010 to roughly the present day. And the important thing is that the UK had no utility-scale solar in January 2010. Okay? And if we go back to the history of solar technology, the first solar panel was actually in 1909 in someone's backyard. That wasn't a big deal. Then NASA came on board, and it started using solar panels for space. And then from the 1970s NASA initiative, it took so many decades to see the first application in the UK at a large utility scale level on Earth, right? So this has taken decades in the making, and the UK is a fairly rich economy, right? So this has taken time. And time is something we don't quite have for this challenge. Now, to give you some data on insurance and kind of long-term power purchase agreements, a question people ask me is, Sugandha, okay, why didn't the private market just give risk hedging products? And this is data on private risk hedging products. And as you can see, the first corporate power purchase agreement for renewable energy was only there in 2014. So you did not have private risk hedging products in this market. And that's essential context, because then you need the government or some other entity to step in and provide risk hedging because the private market is simply not developed. So this is where I look at a long-term risk hedge, and I specifically look at feed-in tariffs, but my message is kind of widely applicable to any type of long-term risk hedging instrument. That can be a contract for difference, a feed-in tariff, whatever. The feed-in tariff in the UK had a couple of characteristics. For 25 years, you knew that you were going to get a fixed tariff. The alternative would have been to get the volatile market price at which you would sell your power. You had a guarantee buyer for your electricity, so you didn't have to negotiate with retailers to ask whether they would buy your power. Your power would most certainly be bought. And the way the feed-in tariff worked was that you had to be less than or equal to 5 megawatts in size to be eligible for the scheme. So it had this size-based threshold. And I would say that there's two channels through which the feed-in tariff would have an impact. So if the fixed tariff is above the market price and expectation, it provides a subsidy. But in addition to that, it is a volatility shield, because as opposed to, undergoing that volatility of the market price, which investors will price in and it can increase the cost of capital, this just cuts that out, and you don't have to price in any risk anymore. You just know, you can forecast your revenues out with decent certainty. And in terms of how high the fixed tariff was, the solid line is the fixed tariff and the dotted line below is the monthly average electricity price. And you can see that the fixed tariff was really high in the early years. That is not where most of my effect happens, actually. Most of my results are driven by things that happen in the later years. And I'll explain why this very counterintuitive result happens. And essentially, in a nutshell, what you can see is that there was an incredible amount of bunching at this policy's cutoff. It is 40 times more than the counterfactual. And that was because firms really valued this long-term risk hedge. And this amount of bunching happened even when there were other subsidies that were in the market that was similar to the feed-in tariff. So the UK had a tradable certificate scheme that actually provided similar subsidies, but they weren't guaranteed over 25 years. So I'll dig into those details. All right, so in the interest of time, let me skip some of these slides, but I look at utility scale solar, which is several orders of magnitude than rooftop installations, and most firms borrow to finance these projects. So they are capital-intensive technologies. In terms of the UK market, it went from a situation where there was zero solar in 2010 to solar growing to about 5% of generation in around like 2019 or so. And this plot just shows you solar entry rates by time. You can see that there's a little bit of seasonality. Every winter it gets dark and depressing, so solar projects don't enter. And then you can see a very sharp drop in 2016. And that is when the feed-in tariff was very diluted to the point of being ineffective. Okay, so I do, firstly, a very simple kind of event study, and I show that there was a little bit of anticipatory entry in the months before the feed-in tariff was diluted. So that's the little bump you see before the dashed line. And then in the months after the feed-in tariff is diluted, there's sort of an 80% drop in the number of new solar projects that happen in this market. This is only time variation, so let's go into something a bit more rigorous. I do come up with a small model, which in the interest of time, I won't go too much into the details, but it just says, as a firm, you have three choices. You enter with a feed-in tariff today, you enter as a market project, a merchant project, or you just decide to wait. These are your three choices, okay? And then essentially what would happen is that the model predicts that there will be some incentive to bunch. So maybe you were deciding to be 6 or 7 megawatts, but now there's a feed-in tariff, so maybe you strategically downsize. The alternative is maybe you were one of the waiting firms, And thanks to the feed-in tariff, you decide to enter the market. So you might enter at 5 megawatts, but that is still additional because you were previously waiting. So you can have you have an intensive and extensive margin response. Either you were going to enter anyway and you strategically downsize, or you are genuinely a new entrant that switched from waiting to entering this market. And the bunching estimator I use will disentangle that. Very quickly, the data I use is electricity prices at 30-minute frequency from Aurora Energy. I want to look at electricity prices that are relevant for solar generators, so when the sun is actually shining. And secondly, I use a detailed project-level database of all solar farms in the UK. So it is the entire population. And I have details on their geolocation, their size, the firm that undertook the investment, and so on. And in that map, you can see all of the kind of red dots are solar farms that took the feed-in tariff, and the blue dots are the ones that didn't. And the empirical strategy uses the 5 megawatt eligibility cutoff. So essentially it sees how much extra mass is there at 5 megawatts relative to an estimated counterfactual. And the way I estimate the counterfactual is I create a window around the financial discontinuity where incentives are being affected by the discontinuity. And then I use observations outside that window to create the no feed-in tariff counterfactual. And I can compare the no feed-in tariff counterfactual to the with feed-in tariff observed data to see how much extra entry was incentivized by this policy. I can also look at how much strategic downsizing there was, because if we see a dip towards the right of 5 megawatts, those could be the firms that strategically downsized. More formally, it is this equation, but I'll skip over that in the interest of time. And this is commonly used in the income tax literature to also look at kind of tax behavior by individuals. So the headline result is essentially that I find as a lower bound estimate that the feed-in tariff is responsible for 2.3 gigawatts of capacity, which is equal to 1/5 of all solar in the UK. And that was brought online in just a period of 5 years. That, in terms of relative terms, it means that there's 40 times more projects relative to a no feed-in tariff world. So this is kind of a significant effect in the sense that I argue that this is essentially creating the market. And it is an underestimate because I only estimate the effect around a really small window where I can have identification. Of course, the feed-in tariff would have incentivized entry at capacities much lower than 5 megawatts. So I don't actually measure that. This is a lower bound. But let's dig into how this changed over time, because first of all, I want to draw your attention to the fact that when the feed-in tariff was diluted in 2016, there is no bunching anymore. So if you look at the gray line here, you can see that the bunching completely disappears once this policy is highly diluted. So that gives us some confidence that it is the policy that is creating the bunching as opposed to other factors that might just make 5 megawatts a good size to choose. But the really curious thing about my results is that the bunching peaks not when the subsidy is the highest, okay? So just to give you a little reminder, the subsidy is highest in the earliest years, but bunching actually peaks much later on. So what is going on? And here the story is that it's actually this phenomenal learning by doing in this market, that the cost of solar panels are getting cheaper. So once you take into that account, my model can show that the value of waiting is actually quite large, conditional on learning by doing externalities, such that when you take those into account, there's actually a strategic reason to enter with a feed-in tariff later, if that is an option. And that is what is overwhelmingly driving these results, that you see that the entry is happening later, not when the tariff level, the subsidy, so-called subsidy, is at its highest. In fact, there's something else that's happening that's very curious in the data, is if I were to plot my bunching histogram for every year from 2010 to 2015, you see that most of the bunching happens just before the policy is going to be removed. And that makes a lot of sense because with the feed-in tariff world, a firm could decide, do I enter with a feed-in tariff today or do I enter with a feed-in tariff tomorrow? And you can really make the choice to enter tomorrow, take advantage of learning by doing. But if you have expectations that the choice will be feed-in tariff today or no feed-in tariff for tomorrow, you will expedite entry and quickly enter while this policy still exists. And that is what I document happening with this huge surge and kind of take advantage of this policy while it still exists. And then the third layer to this whole story is that the blue line, which shows the massive peak in bunching, also coincides with this period. You can see between 2012 and 2015, the purple line shows the price of tradable energy certificates for clean energy in the UK market. And that price is very similar to what the feed-in tariff is offering. So someone can ask, is it the subsidy effect or the volatility shield that matters? And what I do is I look at bunching specifically for those years where the subsidy effect is fairly similar because tradable certificates are offering a similar subsidy at the point of entry as the feed-in tariff. And what you can still see, as the blue line shows, is that firms are selecting around the policy that offers certainty over 25 years. Even if at that point in time, the subsidy offered by tradable certificates and the feed-in tariff was the same, they like the fact that the feed-in tariff price will be the same, whereas, for tradable certificates, it will change. All right, that is basically the end of my talk. I just want to take the last 30 seconds to say, was this really inefficient? Because it did bias entry at 5 megawatts. And the answer is that with a fixed transmission network and actually permitting costs, you do have diseconomies of scale to solar after a certain point. So the efficiencies can be capped by that. That's the final point I want to make.
Okay, thanks a lot for the presentations. Working lunch starts in 1 minute, but I'm happy to take some questions. No, François said, the people here, they are counting in already some delays, so we will have some time to talk. Probably we can collect some questions. If you identify you briefly, and then I would probably collect 3-4 questions, and then we go for another round of comments. So please.
Hello, thank you very much for the presentation. I'm Cristina Pizarro Irizar from the University of the Basque Country. I have one single question for you, Sugandha. I liked very much your presentation. And I wonder, when you talk about projects and you present this beautiful picture with how they were actually installed, do you consider the projects that were awarded with the feed-in tariff scheme or the projects that were operating and generating electricity? Because, for instance, in Spain, now with the renewable energy auctions, you can be awarded in the auction, but it takes 2 years or more until the facility is actually producing electricity because of the permits and the legislation. So this is just my question. Thank you.
Collect questions, second one, and here's third, Kinka.
Hello, again, Yang Zheng from LSE, as Pia and Aurélien. Actually, I have one question from François. So you find that the French program, they increase the green jobs there, but is it like the increase, or is it a new job creation or the transition of the job between the gray and green? And if it's transition, because we see that the treatment and control group, the difference is larger and larger, does it mean that like this program or like even the COVID, they provide opportunity to break the conventional path of labor market structure to the greener path? And another question for Aurélien, actually probably more technical one, because there's more like there's a trend of the more employees especially in the developed countries. They care more about like whether the jobs they are more like they really create something good. So it's more like a corporate social responsibility job. So that means that some of the job ad might be greenwashing. So they kind of pretend to be green. So I'm not sure whether it's possible to like measure whether the strength of the green skills in those job ads. Well, probably you must have solved it, or yeah, has any idea to solve this? Thanks.
Okay, perfect. Now I have Kinka, and the last question will be here by Jose. So.
Hello. Oh, I'm sorry. Hi, everyone. I'm Kinga Tchórzewska. I'm an assistant professor at Koźmiński University, and I'm also a researcher at the chair. Thank you all for your very interesting presentations. I really enjoyed learning about your papers. I have a clarifying question for Aurélien. I was wondering whether those ads are those positions that were filled or just posted, or do you have a way to see how quickly this position was filled if this is the case? Thank you.
Last question would be Jose.
My question is for Aurélien, and also I am still a bit surprised with this decrease in high-skilled workers. No? I think there are now many innovations, and I am wondering if this is happening maybe for some very specific occupations, or can you provide more explanation? And also a clarification question from Pia. I think a key issue is this distinction between clean, dirty, grey technologies. I don't know if this is an important issue in your work, if you have carried out some robustness checks to avoid problems with that.
Perfect. So this will be the last round of replies. I would just add to Jose, because I mean, the grey technology was hydrogen. Why is that a grey technology, not a green technology? While electricity, I think, was a green technology. No, so there are some at least things to clarify, because this is not so clear cut in a way. No, and of course a lot then links to electrification, because electrification needs probably a little bit more AI and machine learning and so forth. No, than other types of technologies. So is it electrification you're picking up in the end? Okay, but probably do the last round of replies, and all the other questions we move to the working lunch.
Well, so are we making the full calculation of what are these jobs new jobs? Are they jobs that are transferred? So there was a massive injection of money into this sector. So you would imagine that there is some additionality in that respect. And what we look at when we look at the construction sector in general, we don't find strong impacts of like transferred jobs from other sectors to this one. So this would point at these jobs being somehow additional. I still want to do more analysis on this. A problem that I have with the scheme is that it's a temporary subsidy that has been that has stopped now, because the idea was to foster it for a while. But then the question is, are these jobs like maintained? And naturally, because of the pandemic, it's very difficult to know. But we could look at like the difference between long-term and short-term contracts in France to understand this. And another problem is that you have some form of macroeconomic effects that you need to take into account, because since you're investing this money there, it means that you're not investing money elsewhere. So, this question of actual additionality of public funds naturally come in there. And there is also the problem of how this is being actually indirectly financed, because this policy indirectly increases the price of energy for consumers. So if you believe that the increase in the price of energies for consumers has a negative impact on employment, that then we're not capturing this. And since we are talking at national scale, 15,000 jobs is a lot, but it's not so much when you look at the whole of France. How in that regard, what we know is that the scheme was not impacting industrial customers because they basically had a way to kind of like get away with it. So it makes me believe that there is some additionality there, but there is naturally, I mean, we are limited in what we can say. At the very least, we can say that when it came to kind of like, when we invest in this sector in this way, there is probably some form of job creation in this specific sector.
Yeah, thank you. That's a really good question. I think it's important to be honest about the fact that all classifications are imperfect. I think in this case, we are taking technology codes from prior literature to classify technologies within electricity and within transport as clean, gray, or dirty. Of course, there's some sort of connection in the sense that the clean electricity will then supposedly feed into the electric vehicles and so on. But I do think that whilst we could argue about whether solar panels actually clean if it was produced in China that, produce a lot of its energy that it uses in its factories with coal, I think we can probably agree that if we're going to mitigate, we need to stop using coal and we need to start using more and more solar power. And in that sense, I feel pretty good about the way that we've classified these technologies as clean or dirty.
Well, thank you for your questions. So Yang, to your first on greenwashing of the ads, that's an excellent point that we are very much interested in. So much so that that's actually part of one of our follow-up projects, particularly as part of the PRINCE project, which is like a joint project with Ralph Martin at Imperial, colleagues at Oxford, other colleagues at LSE in the CEP, where essentially we're looking at firm-level measures of greenness, and we're contrasting various ways of measuring greenness, ours through how much demand there is for low-carbon jobs, but also green patenting, the emission of green bonds, the corporate communication of green targets. And so we hope to be able to assess with this kind of like panopticon version of whether a firm is green or not, to be able to check whether there is greenwashing, and if there is, to be able to quantify it. So stay tuned. I'll be back with more results. Kinga, on the positions, that's also something we would have loved to be able to see. Unfortunately, as rich as this data set is, it's very much a demand side on the labor market. We do not observe the supply side in parallel. However, there is intensive deduplication efforts being made by Lightcast. So each position, no matter how long it remains advertised, is uniquely identified over time. So that's one alleviation of your concern. The other thing is that other papers in the labor economics literature on non-environmentally related topics have had access of subsets of this data set where you do also observe how many resumes were posted for those and whether those positions were filled. And it turned out that even though the way to look at this data set is really as a thermometer of what the demand for various occupations and various types of these occupations is at any point in time, it does reflect quite well how the labor force evolves over time too. And Jose, for your last question, indeed, I mean, it did surprise us initially. I'll totally grant you that. However, so in terms of these sub-occupations, when we focus in the high-skilled occupational groups, it is mostly on the R&D side that there's a decrease, which is why I cited like those findings in the green innovation literature, that there has been a slowdown in green innovation, at least as measured by green patenting over the past 6-7 years. And at least as measured by the demand for high-skilled workers working on R&D for decarbonization, that's also what we find in this instance. Now, that's not to say that there's no need for further R&D. That's just to say that so far, the market is not delivering more R&D in the green space, at least over the past 6-7 years.
Okay, great. Thanks for the question. So the data set has information on projects that were proposed, when they got permitting, when they were constructed. And so essentially, the nice thing about most solar projects in the UK is that you can only get the feed-in tariff if you already have a permit. And then the construction often has also happened quite quickly. So most of the projects are constructed in the sample, but in my robustness check section, I actually do present the results for only the constructed sample versus some of the ones that failed. But yeah, just to allay any concerns, the failure rate is very low. I think only something like 10% of the projects fail. Yeah.
Perfect. So thanks a lot for all the questions and for the replies. So that was, I think, a very interesting session. We have now a working lunch. So Julien, if you want to ask more questions, or all the others in the room want to ask more questions, use the working lunch. And we will resume at 2:15 with a third interesting panel on energy policies and regulations. Enjoy your lunch.